Chamath Palihapitiya is one of those people in the tech industry that when he speaks, most people tend to listen. And time again on the All In podcast, which he is on with a bunch of other people, he has talked about Palantir without mentioning Palantir, almost as if Palantir is an ex-girlfriend that you had good memories with, it ended amicably, and you'll never speak bad on them, but you won't mention them by name. The Twitter thread that he put out today caught my attention for two reasons. Number one, he's talking about SaaS businesses and how SaaS businesses should be valued. And one of the people on the podcast as well, Brad Gerstner, who runs an entire fund that mainly invests in SaaS businesses, Snowflake being one of the top holdings of his fund, actually countered Chamath's point. So I want to go through both of those points. And number two, Palantir seems to be the obvious company he's talking about in relationship to the software enterprise spending space. The tweet thread that he put out was really interesting that we're about to read in a second, because it's kind of a contrarian argument about why SaaS businesses aren't the best businesses to invest in. And obviously, as a Palantir shareholder, you're investing in a B2B software company, which is a SaaS business. And so, it's really interesting when someone in the high tech space who's invested in SaaS his whole life is saying, SaaS is not that interesting. And it's like, well, why? And does Palantir kind of clear a lot of the hurdles that you're talking about in regards to your evaluation of SaaS? So let's get into it. I think this Twitter thread was actually very interesting. We're going to go through it, and then we're going to look at the response and then keep going from there. Chamath says, why is it that the companies with the highest gross margins and zero marginal costs are also, as a group, consistently unprofitable? Which is not a bad way to start this off. I mean, at the end of the day, a lot of SaaS companies currently, especially in the public markets, are definitely unprofitable over the past couple of years. It just seems odd to me. Over the past few years, one hypothesis I have can be summarized as follows. Your marginal advantage is inversely correlated to your gross margin. 90% gross margin SaaS businesses are allowed to have such high gross margins in part because their advantage is more fleeting than other businesses. They have this advantage precisely so they find profitability as quick as possible. And the advantage is once you make it, you can sell it to the entire world. The marginal cost of updating the platform or the software that you create is minimal in comparison to the margin you're going to make when you sell it because there's no fixed labor, hard costs, etc. But so many of these companies do the exact opposite. This hypothesis is important because a default assumption in valuations of software businesses has historically been that at some magical point in the future, investors will see a falling percentage of R&D and S&M expense, that's research and development and sales and marketing, which will create the profit margins that should be possible at 80% gross margins. Obviously, Palantir is one of those companies that has 80% gross margins, not in terms of their net income, but in terms of their adjusted potential margins for their software. Again, there are exceptions, but the rule trends as long as towards long-term unprofitability. While high GMs and lack of COGS may seem like the greatest business model of all time, I don't think it's the free lunch people think it is. So Chamath here is having a contrarian take on what it means to invest in a software company. In many cases, it also unintentionally creates a higher probability of a funded competitor or a series of competitors that ultimately whittle away product advantage. When this happens, that future window of profitability will likely never come. Here, I think he's kind of referencing his experience with Slack. I mean, he ultimately ended up investing in Slack and selling Slack to Salesforce because he saw that Microsoft Teams had all the distribution. Slack is just a software product at the end of the day that doesn't really have a moat. I mean, its moat was that a lot of people were using it, I guess, if that's a moat. But the software can wither away in terms of competitors that can just undercut you on it because the R&D and the sales and marketing is not that expensive for a software product because it's just software at the end of the day. There's, it's not like making an airplane, which means anyone can do it. At the other end, the software businesses that seem to overcome this are not the ones that eventually find profitability per se, but those that are much more prudent upfront about how to get out of a J curve, seem to understand pricing and demand dynamics, but also seem to have fewer competitors as a result of all of these. Who do we think he's talking about there? In my opinion, I don't think he's literally talking about Palantir, but as a Palantir shareholder, I'm thinking, well, the company that has unique demand dynamics in terms of other enterprise clients that really want their software, understand pricing, what is Karp's entire argument, right? We're going to give the product to the client for 12 months, 18 months, let them use it, and then they tell us what they think it's worth. And after you use it for 12 months, it's worth a lot of money because obviously it's transformed your business. And so there's kind of a unique pricing strategy there, and have fewer competitors as a result of the pricing and demand dynamics, meaning you don't need to sell it in a sales call and get that $5 million deal. You can give it for free, and then in 6 months, because it's so valuable, because the software actually is not a piece of horse crap, you can charge a lot more than $5 million. What is the summary? Huge GMs are your friend if you have them, gross margins, but they aren't a substitute for growth at all costs and indeterminate periods of unprofitability. Profitability matters, and finding operating leverage as soon as practicable is going to increasingly be a necessary condition of high valuations. As more and more public companies are going to be tech companies, it is only logical that investors will increasingly prefer the profitable ones over the unprofitable ones. And we've kind of seen this with the entire market cycle. That's why it's so important that Palantir is going for GAAP profitability while hopefully not sacrificing growth, because obviously the market has said with interest rates at 5%, we are not going to invest in you if you are not profitable. We are not going to give you the premium that you deserve if you cannot justify that you're doing right by shareholders and ultimately, fiscal responsibility writ large by generating a profit. The goal of a company is to generate a profit. You've got to get to net income profitability, and we understand you're growing, but if you're not growing at 70-80% year over year, which Palantir is obviously not, then you got to get to profitability for us to be able to invest in you. Now, Brad Gerstner runs a fund, and he had an interesting argument against this that I want to explore, and then we'll go back to what Chamath said. So on the podcast, Chamath said that software generally is not helpful because all these are unprofitable software companies sucking the wind and losing money. He says, and while that was not really Sachs's point, who is the other guy on the podcast, it is an important one to address. Are software companies bad business models? So I asked the team to pull together a few charts. Of the 61 companies in the index, only 6 have negative free cash flow margins, which is really interesting, right? Out of the 61 companies that he mentioned, only 6 of them have negative free cash flow. Now, free cash flow doesn't mean profitability. Free cash flow doesn't mean net income, but it does mean that cash is going through the business and that you are able to operate the company because there's money coming in and it's not being completely drained by all the operating expenses of the business. So not bad that 61 of those companies that are sort of major software players actually have the ability to be free cash flow positive. Palantir is right there on the chart if you can see it. I believe they did like $420 million or something in free cash flow last year, something like that. So Palantir is free cash flow positive. And it appears they have traded off some growth to get more fit. So here he's showing the dynamics between a company in terms of their revenue growth, which is the gray line, and their median free cash margin. So as you can see, as it goes down, the free cash flow margin goes down. As it goes up, the free cash flow margin goes up. And we can see the sort of dynamics of how you trade off some growth to be able to get more free cash flow margins. And like Microsoft, Oracle, or now, they tend to get more cash generative over time. Snowflake going from huge negative free cash flow to $4 billion annually, according to estimates, and already over 20% margins. Brad has a outsized position in Snowflake in his fund, so he's been a very big Snowflake bull for a long time. Snowflake has 8,000 clients. Snowflake is the epitome of one of those software companies that just scales, and eventually, should be a very, very good company that's very, very profitable. The question is just the valuation, in my opinion. At $60 billion right now, it's a lot. He also says we should consider stock-based compensation. No doubt that needs more scrutiny for both enterprise and consumer businesses, but the facts are that software is a pretty damn good business model. It seems to work for Microsoft at $3 trillion and counting. Now, the interesting reason why I wanted to bring these up is simply because Chamath is taking a more contrarian take that says software companies aren't that interesting because they can't get profitable. So you've got all this R&D, you've got all this sales and marketing, and you do all of this to be able to get a product that essentially has 80% gross margins, right? You're like printing money as long as you're able to keep selling it, because once you do the R&D, the product is done, sales and marketing costs, boom, you've got, for every dollar, you get to keep 80 cents, which is just, it's a beautiful business. There's very few businesses in the world where for every dollar, you can keep 88 cents or 80 cents. But the problem is, so many of these companies are not actually profitable. Brad's point is like, yeah, they might not be profitable, but they're growing and they sacrifice a little bit of that growth in order to get free cash flow positive, when price to free cash flow is actually one of the best metrics you can use for a business, because free cash flow is something that cannot be manipulated. It is the money coming through the business that is actually available to be able to be spent. And so even though those companies aren't profitable, if they are free cash flow positive and they have the ability to get profitable, like an Oracle, like a Microsoft, like a Snowflake over time, like a Palantir, then they are incredibly good business models, because obviously if you have a product that is generating you 80% gross margins, it's a pretty damn good business. Stock-based compensation is something that he says we have to think into account, and Palantir's stock-based compensation has come down pretty dramatically over the past couple of years. At one point, it was 70% of revenues. Now it's about 30%. Snowflake's actually went up last quarter. So, I mean, at the end of the day, these businesses are really important businesses. Now, one thing that was really unique under this is our own Arnie commented in the Palantir community, competition is for losers, which is the classic Peter Thiel line. And Chamath says, I really agree with this. Do hard things is a way better business strategy. Most people look and say, no way. And Arnie says, the key seems to be having companies that solve the unsolvable and then have a culture able to reiterate it. This was such a great exchange with our own Arnie from the Palantir community and Chamath, because Arnie's argument is like, well, basically your thread is pointing to the simple argument that if you are a software company that has no competitors and you have a dynamic that allows you to control demand, control pricing, demand being your product is so good people want it, pricing means they'll pay whatever they want for it, and then you can just scale the crap out of it, well, you've got a hell of a software business to invest in. You've got a generational company, but only if the product, which is why people give, Palantir a lot of shit for not being great at sales, but the product has to be phenomenal to survive in the competitive software market that we live in, and hopefully sales can be fixed over time. And then Chamath basically says, yeah, I agree. Look, doing hard things is a way better business strategy. Most people look and say, no way. And so his argument here is that, like, most software companies are trying to build the software that eventually gets commoditized by a bigger company, or because the R&D is so little to be able to create it that anyone can do it. Whereas Palantir has 20 years of experience. The R&D they've put in comes with 2 decades of research, which is why AIP, their new artificial intelligence platform, was able to be launched in 2 months, because they had all the back end basically done. All they have to do is put up a fancy design, and then boom, you're good to go, and now you can market it because you've actually developed it over the past couple of years. And that R&D has led them to create a defining moat that is hard to replicate. There is a reason Snowflake's not in Ukraine. And so when you think about a company from that perspective, in terms of the competitive dynamics that it has in the marketplace, and yes, it has some issues here and there, but is the growth able to accelerate at such a level because there is no competition, and then that growth is profitable growth because the company actually has the margins to support it, with all the other business dynamics getting into place, like stock-based compensation coming down, free cash flow going up? I would argue Palantir is one of those companies. And Chamath is someone, I respect in the Valley, and it seems like he agrees with that. Obviously, he's not talking about Palantir, but he's obviously talking about a company like Palantir, a company that has done the hard things, that cannot be replicated as easily as, Microsoft, Amazon. They could do something like it, but they can't actually do what Palantir does. And this is not me hypothesizing this. I've said publicly on the channel, I've talked to people who work with Palantir in the data industry, people with 10, 12 years of experience working with Palantir day in, day out, saying this is something that other companies can't do. There's a reason we're paying for Palantir. Now it's a question of, can they scale that? And if they can scale that, they will be one of those software companies that has the gross margins, that has the research and development, and that has the profitable growth to actually be a SaaS business that is worth investing in over the long term, proving that maybe all SaaS businesses aren't the best, but Palantir is one of those that probably will be a decent one if things play out over the next 10 years. So those are my thoughts. Let me know what you think. Thank you guys so much for listening and watching. Please subscribe to dailypalantir.com/subscribe, my email newsletter every day. I'll see you guys in the next one.